Hi, it's Mohamed here. With spring and the summer season upon us, and with a flurry of buyers in the market, I thought today we might have a chat about the things that lenders look for when they're assessing you for a new loan. Today I'm joined by Corinne Jacquin from Mohamed Said Advisory Services. She's going to tell us about the 4 C's.
4 C's of lending, Mohamed. Thanks for having me.
Cool.
Excellent. Look, I know you're sort of saying that everyone's want to buy a house, but the thing is, like, you have to go for a loan application. Everyone knows that. And understanding how the lender looks at you and your loan application and rates it will actually depend if your application is successful or not.
Wonderful. I liked when you were explaining to me, we're talking about when you're going and you're buying diamonds, there's the same 4 C's of buying diamonds.
Yep.
Cut, clarity, and
Color,
character, and color, and those kind of things. And today you're going to tell us the C's of lending.
Excellent. Look, the first thing we would talk about is character.
Yep.
Okay. Well, the bank wants to know if you're credible as a borrower. Well, have you been responsible paying your debts? If you've got a car loan, have you ever been late?
Right.
Yeah. So that's what the bank looks at.
Okay, excellent. So it's kind of your credit score.
That's correct. Yeah.
Excellent.
I don't know if you know that, Mohamed, but everyone's got a credit file. It's like
Wonderful.
a big brother
Yes,
of
yes.
lending and borrowing.
You can get your credit file by jumping onto ASIC's Money Smart website, and they've got various different online tools that allow you to get your free credit report, if I'm not mistaken. Excellent.
A lot of agencies out there will give you your credit score for free.
Awesome.
So just Google it and go for it.
Go for it. Excellent. Wonderful. So what is the second C?
Okay, second C is capacity. Capacity, big word, but then everybody knows you have to be able to repay or service your loan.
Yes.
The bank is very, very tough with that, and you have to prove to them that you can afford to actually repay every month or every week your loan. So they're going to assess you on the current rates. At the moment it's around 4%, but then they're going to look at, okay, if tomorrow the rates go up, maybe to 7, 8%, can you still be able to afford it? Is what the bank looks at.
Right. And tell me, would they also, they obviously will also look at your other borrowing that you have, so your credit cards and those
that's
kind of
correct.
things.
They will take all of that in consideration, and also very important at the moment is the living expenses.
Right.
Yeah, the budgeting. Well, how much are you spending on entertainment, on movies, on groceries? Everything is factored in, and then it will find out if you're actually able to repay.
Beautiful. All right, excellent. What is the third C that we've got to...
Oh, third C is capital. Well, capital in terms of borrowing means the deposit that you actually have available to put on a house that you want to buy. Okay, most lenders nowadays will make sure that you have at least 20%. 20% is really, really big in terms of houses in Sydney and Melbourne. But then, of course, if you have it perfect, then you don't have to pay.
Yep.
Pay a very, very important premium. It's called LMI. A lot of people say, okay, LMI, what is that? Lender's Mortgage Insurance. So the bank wants to make sure that you can repay your loan. So, well, if you've been able to actually save to get the 20% deposit, fine. But then this is only one-off premium anyway, but it protects the lender, not the borrower.
Oh, okay, excellent. And also, I suppose if you don't have a sufficient deposit in the lender's eyes and those kind of things, that can also affect the rates that they offer you.
That's correct.
A higher lending that you're doing,
they're
taking a bigger risk, so then they want to charge you a bit extra to cover
That's
themselves.
correct,
In that sense.
Yeah.
Right, beautiful. I think we're on to our final C.
Yeah, definitely. Collateral is a final C. Again, a big word, but it's actually means security. Okay, you want to buy a house tomorrow. The bank wants to know, okay, what happened if you can't repay the loan? They're going to say, well, is the house that you're buying actually valued at the correct price, market price? Okay, so in the event that you can't repay, they will have to sell the house and try to recoup their losses. So every bank or every lender will send a valuer to the house that you want to purchase and value it.
Okay, so they're actually reviewing that particular house. So it's features, its location,
that's
the age, and all those kind of things as well.
Excellent.
Excellent. Wonderful, wonderful there. Any other final thoughts or things to
No, well,
leave
what
our
I can
viewers?
say, Mohamed, if you think about all these factors that actually just changed and are looked at by the bank, you got to think about it. Maybe it's worth your while to actually go to a mortgage broker.
Yes.
And I'm a mortgage broker. And the thing is, you can just work with me and I will prepare your loan application so it goes through straight away.
Wonderful. Excellent. So, are your 4 C's all lining up? Come and speak to Corinne. She'll look after you.
Thank you.
Welcome. We look forward to seeing you again next time.
Bye.
Thanks.